Valuation of uncertain cash flows, like the previous speakers already did, but I will take this point of view of the insurance industry, and I will talk about the pricing problems. That doesn't work. Oh, okay. So I will be talking about these two pricing problems that are relevant in insurance industry, and they have also been discussed in the net finance context in many papers over the years. So the first one, which I will call reserving, could be called maybe capital requirements also, or technical reserves, like the people in the industry like to call it sometimes. And it answers the question that of what's the least amount of capital that you should put aside in order to cover some insurance liabilities. And insurance liabilities are like insurance contracts that you have sold to your customers, and then they obligate you to make the claim payments until as long as the insurance contracts are valid and some risks realized. So paying out uncertain cash flows, very much like in option pricing in general. It's just that these cash flows are often more complicated, and there are exotic risk factors, but mathematically it's just the same, uncertain cash flows. And then there's another problem. So the first problem relates more to accounting and supervision. These insurance companies have to put up a number for their liabilities in the financial statement every year, and that's a number that supervision is very interested in. But there's another question also, which also deals with pricing of uncertain cash flows, and it has to do with more of a subjective view of the company. That when company already has some liabilities, and then a new customer walks in and wants to buy an insurance contract, and then the insurer asks the question that what is the price that he should charge for the new contract. And of course he shouldn't sell it for too cheap. He doesn't want to worsen his existing financial position. And it is a very different problem from the first one. Both are pricing problems in a sense, but in incomplete markets the answers are usually very different. If you go to complete markets, there's no distinction between the two. In the Black-Scholes model, you don't need to make a distinction between reserving or pricing. Those things turn out to be the same. But in incomplete markets, it's not so. And in this talk, I will phrase the problems in terms of optimal hedging or asset liability management. And in the first part of the talk, I will try to make the connections to the classical risk-neutral pricing. And then in the second part of the talk, I will look at this application from the Finnish pension industry, where I will be calculating the first number for a big pension portfolio. And the main message I will try to convince you is that these pricing problems in practice, pricing based on hedging of complex insurance products, is a very complicated problems. We cannot come up with exact answers. The best you can do is to do some numerical computations, and you can always do that better. So I'm not solving the problem. So there are many improvements that could be made. So I would say it's a very interesting field. And the way I will proceed, I will start from the basic principles. If you go back to the classical paper of Black and Scholes, they phrased the pricing problem exactly in terms of hedging. There were no risk-neutral measures yet. And then the first problem that I'm talking about, the reserving problem, it's very much related to risk measurement and these risk measures that we heard in the first talk by Dirk Tasche today. And then the second problem, this more subjective pricing, it's very much related to this indifference principle. Probably the most famous paper is by Hodges and Neuberger from 1989. So I will read you the same things in this multi-period framework, where the claims may have several payout dates, like insurance contracts often do. And that's very important, because these contracts have several payout dates because there's no cash account in practice. The insurance company cannot go short on the cash account and postpone the payments until the end. So that's a feature in the market model. I won't assume the existence of a cash account, and that's what motivates the existence of this kind of contracts with many payout dates, and including many swap contracts. What I'm going to say today is based on these 3 papers roughly. Petri Hilli and Matti Koivu are my ex-students from Finland, and Helena Aro is a current student. She's defending her thesis this summer. She has been working on stochastic modeling of mortality risks. It's a very challenging, very fashionable topic nowadays, and there again there are many open problems in the statistical modeling of these things. You need these models before you actually start pricing things. So you need to describe the risks and the uncertainties. And the first part of this talk is mostly based on this manuscript that I wrote, where I try to, starting from the hedging principles, try to relate these 2 pricing questions to the classical risk-neutral pricing paradigms. So I start with the model, or I start with the problem. So I'm looking at an insurance portfolio of a company, and I will denote the let's say yearly payment. So you may think about like a pension insurance company, which is what I will be looking at the end. The liabilities extend over several decades because the injured people, they do require pension claim payments for many years to come. But eventually everybody will die, so there's some terminal payment date, so it's a finite horizon problem, unfortunately for us. But I will denote the yearly payments by CT, and that covers all the payments that the company has to make in a given year to all the injured pensioners. And what makes this a financial problem is that after paying out these claims, the insurance company invests its reserves and any surplus money in the financial markets and try to make a profit so that it would be better able to cover the claims in the future, and also maybe to make profits to its shareholders. And I assume that there's a finite set capital J of assets where the company invests, and the investment return over year T in asset class J will be denoted by RTJ. And then the amount of wealth that the company decides to invest at time T to be held over the next year in asset class J will be denoted by this lowercase h. So those are the decision variables. They describe the hedging portfolio. And I will model the uncertainties in the claims and in the investment returns by modeling them as random variables in some general probability space. And then, as is usual in math finance, you're looking for investment strategies over time which are adapted to this available information. So there's some underlying sigma field of information. And here's the basic optimal investment problem that I will be looking at throughout this talk. And I will use this to formulate the pricing problems in a minute. So here are the budget constraints. I will denote the initial amount of wealth of the company by minus C0. That's a funny notation for the initial capital, but it turns out to be convenient. So this is the time zero budget constraint. The amount of money that the company invests in the financial markets has to be less than or equal to the amount of wealth it has. And then over the following years, at the beginning of each year, the company collects the investment returns that it got from the previous year's investments. Then the company pays out the claims of that year and again invests the remaining money in the financial markets. So those are the budget constraints, and those are required to hold almost surely over the whole investment horizon until time capital T. So the claims here, as well as the initial wealth, they are some given. The initial wealth is deterministic, the claims are stochastic, and the objective of the insurer is to find an investment strategy that covers the claims and ends up in a terminal wealth, which of course is random since the investment returns are random and the claims are random. But we are trying to, or the investor is trying to optimize the risk-return profile of the terminal wealth. So R here is some convex risk measure. It's not really important what it is for what I'm going to say, but I just need it to be convex and that it vanishes at the origin. So if he ends up almost surely with the zero wealth, then the risk is zero. That's what I need. And throughout the talk, this script ND denotes the adapted investment strategies that satisfy point-wise some given portfolio constraints DT. So it's this DT that can be modeled to non-existence of a cash account. So for example, you could have short sales constraints here for the bank account and so on. You could also have upper bounds or some other nonlinear restrictions. And now, from now on, I will denote the optimum value of this problem for a given sequence of these random variables C. The optimal value will be denoted by this phi of C. So it depends. I write explicitly the dependence on the initial wealth and the random liabilities, the random claims. So that's a very important thing. It turns out to be a convex function on the linear space of adapted cash flows. It's increasing in the pointwise order, and that's about enough that we will need for the mathematical analysis of the pricing problem. So here's the first pricing problem. That's the reserving for given sequence of insurance claims, these CTs. So the problem here is to find the least amount of initial cash that allows you to cover with the investment returns of that initial cash. Allows you to cover all the claims until the time capital T, and it allows you to end up with a terminal wealth after paying out all those claims, with a terminal wealth that you are happy with in the sense of this risk measure. So the risk of your terminal wealth is allowed to be good enough. The fact that I put zero here is just a random choice. It could be any other constant. The idea is to look for the least amount of capital that allows you to hedge the claims at an acceptable level of risk. That's what the problem says. And that you can write down under very mild assumptions that I didn't write down here. You can write down the optimal value of this problem, the optimal reserve, in terms of the optimum value function of the previous problem, the asset liability management problem. So this phi again is the optimum value in the asset liability management problem. I go back to the previous slide just to remind. So this is the asset liability management problem. Here we are minimizing the risk from terminal wealth, whereas here the risk is a constraint and we are minimizing the initial investment. So the optimal value of this can be written like this. You are offsetting your claims by a lump sum payment of alpha units of cash in the beginning at time zero. And you're asking as little as possible that makes you happy enough, in the sense that the optimum value, which was the risk, becomes non-positive, which is this constraint here. So this will be useful not only in mathematical analysis. Remember that this guy here is convex. It implies actually that this function is convex. But it will be also very useful in numerical analysis when we go to pricing of things, to calculate these things numerically. That comes down to a simple line search and the problem of calculating the optimal value of the asset liability management problem. And that's what we use in practice. There's an interesting special case is when the risk measure is such that it's non-positive if and only if its argument is almost surely positive. In that case, this problem becomes the classical superhedging problem. You're looking for the least initial capital that allows you to cover all the claims without any risk of ending up in a negative wealth. And I will denote that special case by this pi 0 sup. And I'll also define the what's sometimes called the subhedging cost. It's the least amount of initial cash that you can pay risklessly in exchange for receiving those random cash flows. See, it can be written in terms of the superhedging cost like this. And we say that the sequence of claims is replicable if the superhedging cost and the subhedging cost are equal. That happens, for example, in the Black-Scholes model, when all claims are replicable by some dynamic trading strategy. Then you have this. And here's the main result about these reserves. It says that the reserve as a function on the linear space of all sequences of adapted cash flows. It's a convex function. It's non-decreasing with respect to the pointwise order on the claims. And it's non-positive for zero claim. A very natural thing. And all this is very easy to prove. All the mathematics behind this is just simple algebra. It's about 5 lines of simple convex analysis. But then the main thing is that if the capital requirement for the zero claim is actually non-negative, then you have this sandwich inequality, which says that the capital requirement for any convex risk measure, it lies between the superhedging cost and the subhedging cost. So then you see that if the claim is replicable, which is the case where these two are equal, in that case the capital requirement for any risk measure actually equals the superhedging cost. So in that case only, the capital requirement is independent of these subjective factors, the probability measure in the pricing problem and your risk preferences. But in general, of course, insurance claims are not replicable. So insurance claims and these reserves for insurance claims, they very much depend on these subjective things, on the views that you expect to get as investment returns from the financial markets, your views concerning the development of the claims, how long people will live, and how do the indices that these benefits are tied to, how those things develop in the future. They are very important when you price these things. And also the risk preferences. If you have very strict risk tolerances, then the prices will typically be higher. But again, for replicable claims, these things don't depend on those subjective things. And what I'm talking about here, these reserves, they can be interpreted very much like these classical risk measures that we heard earlier. If you read the paper by Arsney, Delbine, Aber, and Heath, the terminology they use is pretty much exactly what I'm using, and the interpretation. The main difference here is that we don't assume the existence of a cash account. So the capital requirement here, it doesn't have this translation invariance property. The translation invariance for risk measures has to do with the existence of a cash account. That's not what we assume. And another difference is that we are looking at sequences of cash flows. And again, that's because we don't have a cash account. And here's just a remark about the new Solvency II, or the actuarial pricing in general, which I guess for historical reasons in the Solvency II framework, in the actual directive of the European Union, they propose to price insurance claims by taking simply the discounted expectations of the cash flows. But that's, to be honest, it's nonsense. You shouldn't do that for uncertain cash flows. And they realized that in the Solvency II, and then they proposed to add a risk margin to correct for these uncertainties. But that doesn't work either, because the risk margin is always positive, whereas this silly expected discounted value may be too high to start with. If you price European options by discounting the expected values, you get something which is much too high, much higher than the market prices or the Black-Scholes prices. That just doesn't work. And then here's the second topic. This is the indifference pricing. But here again, since I don't have a cash account, I will, rather than looking at lump payment at the beginning, I will be looking at swap contracts, which are typical in insurance, but also in other sectors of financial markets. And in these swap contracts, there are two sequences of payments that are traded between two investors. There's a claim sequence, this C, and a premium sequence, P. And the question is, what multiple of the premium sequence would be enough to compensate for delivering the claim? And here it's important that we take into account the possible existing liabilities that the insurer already has before this new trade. So it has this existing insurance portfolio. A new customer walks in and wants to buy another claim, which would add to the existing claims. And then the insurer has to ask what premium to charge for this. And he asks for, well, in this indifference pricing formulation, he asks for the least multiple of the premium sequence that allows him to enter the contract without worsening his risk return profile. Again, measured in terms of the optimal value of the asset liability management problem. And this is very much like you see in the Hodges and Neuberger. It's just that instead of looking at initial payments, we are looking at swap contracts and looking for the indifference swap rate. And what could be the premium process here? If you choose the premium process to be this, which only involves a lump payment in the beginning, then you're back in the Hodges-Neuberger pricing framework. But if you take something like a interest rate swap, there you have a sequence of fixed payments. And you could take something more complicated like CDS contracts or CDOs. And there the premiums are random because they stop at the random time when the counterparty defaults. So that's an example where you have truly stochastic premiums. And we'll also define this buyer swap rate, which is just the maximum premium rate that you could afford if you're taking the other side of the trade. So instead of paying out these claims, you now receive them, and in compensation you deliver this multiple of the premium. And for these indifference swap rates, we have a very similar result as we had for the reserves. If you assume that the swap rate for the zero claim is non-negative, then you have again this kind of sandwiching inequalities where in the middle you have the buyer swap rate and the seller swap rate. And that middle inequality is saying basically that if you have two identical agents with the same risk preferences, same views, and the same existing liabilities, C bar, they have no reason to trade with each other. It's a very natural thing. You don't sell anything to yourself either. But if there are differences in these subjective factors, then there may be incentives to trade, and that's what we see all the time in financial markets. And this, well, I'd like to emphasize the fact or the role of the existing liabilities. I think that's the biggest reason for the existence of most financial products. But the financial products are often created for agents to share risks in their existing positions. You may have exposure to some risk that you want to trade away, and I may have the opposite exposure. And to take that into account, you have to take into account these existing liabilities. That's something you don't see in the Black-Scholes model, but in the Black-Scholes model, since it's a complete market model, it doesn't matter. And then the second message is that both these indifferent swap rates are bounded between the superhedging swap rate and the subhedging swap rate, which are defined like this. So they are defined as the swap rates that allows you to enter a contract without any risk. And again, if you have replicable claims, these two are equal, and for those claims you'll see that the indifferent swap rates are independent of any subjective factors. That's again what happens in the classical complete markets. Okay, so I will now go to that's what I wanted to say about the mathematical properties. And again, all that I just said are very, very simple. There are no functional analysis, or there's no topology, so there's no fancy mathematics behind these results. They are basically 5-line proofs, just playing with convex functions and their properties. So in this example, I will be looking at the claims coming from a huge pension insurance portfolio. We basically took all accrued benefits, pension benefits, from the Finnish private sector pension system. Not just from one particular company, but all the liabilities from all the companies that manage these liabilities. And then we calculated as best as we could the optimum or the minimal reserve for these liabilities. How much time do I have? So the claims, they come from the pension liabilities. They depend on they include the old age pensions, disability pensions, and also some small fraction of unemployment pensions. And the underlying risk factors are the longevity risk, so the risk, the uncertainty about how long people live, because we have to pay pensions until they die. And in disability, there's a risk of when do they fall disabled to work and start earning this or start receiving these claims. And also the benefits are indexed. The Finnish pensions, they depend on the price and wage inflations on their development over the years. And I'm not going to describe the stochastic model for these risk factors in details. Here's just a simple picture. The picture on the left is real data. That shows you how Finnish males have died over the years. So here's the time. It starts from early 1900 and goes up to 2006. And here is the age. And what you see in this graph is the fraction of Finnish males that survive over a 1-year period. So you see that young males survive, or higher fraction of them survive than of the older males. And that's kind of natural. You may also be able to see that there's a slight, well, you can't see it in this picture, but there's a longevity improvement. So that's a global phenomenon. People tend to live longer and longer, and that's a huge issue in the pension industry nowadays. And there's a big uncertainty about that development. And there you see there's the Second World War, the Winter War in Finland. There's a big dip, and then there was this disease 1916 that affected much of Europe, the lung disease, or what it's called. And then on the right-hand side picture, the way we model this is we model the probability of survival by binomial distribution. And we fitted binomial probabilities for all age groups in each year. We parameterized the binomial probability curve at each year by 3 parameters. And those will be the risk factors for which we develop a stochastic model and then simulate in these numerical pricing problems. And this is the result. After we modeled also the price and wage inflations and simulated them, this is the picture that you get for the pension claims that were associated with the benefits accrued by the beginning of year 2009. So you see that when the large age groups start to retire, the yearly claim payments go up. So what you see in the picture is at each point in time you see the median and 90% confidence interval of the yearly payments for that year. So first,
how do you incorporate medical advances, non-stationary behavior in the...
You would incorporate that in the model for the underlying longevity risk factors. Like
sometimes those can be step jumps.
of course, that's why these are that's where the uncertainties come in. So what we did was a very simple stochastic model. So we modeled this by only 3 risk factors, which already is a huge simplification. But if we do capture many of the features in the real data. And the problem is now to model these risk factors. We have written papers. Well, there was a reference in the first paper with my student who's defending her thesis this year. And her problem was exactly this. How do you model the behavior of these risk factors over the future? And you have to ask exactly that kind of questions. What are the factors that may affect these risk factors? There are many important factors that we have no idea of. And that's where you have to put a lot of uncertainty into your model. So big volatilities into the stochastic process for these risk factors.
There's a big difference between volatility and step jumps.
There is. And we have a discrete time model here. We only look at the yearly developments. And you may have and you should have fat tail distributions for these stochastic processes. And that's a very important question. And there are some features that you see in the development here. Well, here you actually see the 3rd risk factor. And you see that there's some trend going up. And we found out in statistical analysis that this is roughly related to the GDP development. And I guess the logic could be that when the nation has more wealth, it can put more wealth into the health care of the old people. And the longevity of the old people is very much affected by that. But these are very simple models, and we have to keep them simple in order to be able to compute anything. But those are very important questions, and again, there are many improvements that could be made into these kind of models. And it's these stochastic mortality models, they are a very hot topic nowadays. There are many experts in the UK working on this. But these are very, very new models.
There's also these products like longevity swaps that
Yes.
They are sold to pension funds to
Yeah.
hedge this risk.
Exactly.
But they're subject to counterparty risk themselves.
That too. And how do you price those products?
Yeah, exactly.
That's exactly what I'm talking about here.
Yes, yes.
So then there's also risks in the financial markets, in the investment returns that the company gets for his financial or the asset portfolio. And in this simple study, we only look at 5 equity indices on a yearly level and 2 bond indices. So we only have 7 asset classes in this problem. And we model the bond returns by using this formula, which gives an approximation. It gives a good approximation of the yearly returns in terms of the yield of a basket of bonds. And here the D is the duration of the basket and C is the convexity. And those parameters again are fitted using a statistical analysis. And then we will model the market risk factors together with the liability risk factors, which were the mortality indices and the price and wage inflations. We will model them together in this multidimensional stochastic differential equation. where the parameters A and B, some of the parameters in the matrix A and vector B are estimated from historical data. Some are determined by expert views. For example, when we work for Finnish pension funds, then the managers have strong views about the development of the stock market, so the level of the future yields of some bond sectors. But anyways, that's another story that I could talk about, but I won't today. And once this is done, then you basically have a mathematical description for the assets and the liabilities and the certainties in them. And then I will look at this reserving problem. So I will try to find the least amount of initial cash that would be enough to cover all those pension liabilities at a given level of risk. And we'll compute this. We can only compute this numerically. We get only rough approximations. And like I mentioned in the beginning, the strategy is to make a line search with respect to alpha. You fix it, you solve the asset liability management problem as well as you can. If the value is bigger than 0, you know that you need more cash, or you need to solve the problem better. But there are limits to how well we can solve it. So we just increase the cash then and then solve the problem again. And to solve the asset liability management problem, to numerically evaluate this function phi for a given sequence of liabilities, we use this simple Galerkin method, which takes a bunch of trading strategies and tries to find an optimal diversification of the initial wealth between those different strategies. So basically we are taking a bunch of strategies and then take a convex combination of those strategies. So here's again the asset liability management problem that we are trying now to solve for some fixed C. So when we do the line search, you should insert this thing here in the place of this C here, and then solve this problem. And the way we do it, we use this Galerkin method where you try to find first a finite collection of any strategies which are feasible in this problem. So that means that they are adapted, satisfy the portfolio constraints and also the budget constraints. And if you look at the literature of math finance, there are many such strategies. I guess the most well-known is one from the Merton problem, which is like a fixed proportion strategy. You invest in some given proportions in different assets. You go 1 year ahead, you pay out the claims, you look at how much money you have, and you again rebalance to those same proportions. And then you go on. And there are other strategies like the portfolio insurance strategy or simply the buy and hold strategy, or it could be anything. And there are many, any improvements in these directions would allow you to reduce your capital requirements. You may come up with better strategies. We, in this study that I'm going to show in a second, we used some like 500 different strategies and then did the optimization. But if you can do improvements there, if you can guess better strategies to optimize over, you may be able to do much better than we did. But anyways, this is the idea. If you have a finite number of strategies, these HIs, then you just need to evaluate the terminal wealth that you get if you follow that strategy. And you know that your problem is convex. Well, I didn't emphasize that, but these describe a convex subset of the space of adaptive trading strategies. If you take any convex combinations of strategies in that set, you remain in that set. So when you take the convex combination of feasible strategies, you will know that you will be feasible and adapted. So you will be in this set of trading strategies that satisfy the portfolio constraints. You will also know that taking the convex combination, you also satisfy the budget constraints. So all you care about then is the objective value. And the way to do it numerically, you for every given strategy HI, you evaluate the terminal wealth. That's a simple simulation problem. And then you just look at the random variable that you get by taking convex combinations of those random terminal wealths. And then you try to find the optimal convex combination. As a finite dimensional optimization problem, it's convex, which is a very good thing. But still the objective can be hard to evaluate. Now if you assume that you have like a function which is like the expected utility or disutility, you may also have the conditional value at risk or the expected shortfall. You can formulate it in terms of the expectation. As long as you can formulate the objective in terms of expectation, you can approximate it by using integration quadratures, which is just a fancy term for making a big simulation. You make 500,000 simulations and then assume that you have a good approximation to the risk measure. And that's what we do in practice. And that gives you a finite dimensional optimization problem that you can solve in MATLAB, for example, using standard convex optimization solvers. And what we do here, if anybody knows the finite element method for PDEs, the elliptic PDEs, this is exactly the same. You have a number of basis functions. You solve over the multipliers of those basis functions. And this last step here, when we do the numerical integration, that's exactly what you have to do in the finite element method. If you have non-constant coefficients, you have to integrate over the elements. The main difference here is that while in PDEs you usually look at 2 or 3 dimensional domains of integration, in this problem we typically have thousands of risk factors since we have several time steps. So we are looking at integration over very high dimensional domains. And that's again a big problem, and that's an active field of numerical analysis, how to integrate over such domains. Well, here are the results. We did the optimization. We had 529 different kinds of feasible strategies. And what we used here were just buy and hold constant proportions, like in the Merton problem, and also portfolio insurance strategies, and what's known as target date fund. Target date fund is a strategy where you reduce the proportion of risky investments as the retirement date approaches. And when we did the optimization over those 529 strategies, it turns out that there's only 7 strategies which got non-zero weight. And the strategies were of this type, so buy and hold, 1 constant proportions, 3 portfolio insurance. And these are the weights, they sum up to 1. And what's interesting here, although it's just a heuristic, since we don't get any convergence results or anything like that, but we do get surprisingly nice results. If you look at, these are the objective values in the asset liability management problem that you would get if you used only a single strategy. And by the way, here we used tail expectation, the conditional value at risk, as the risk measure. And these are the numbers you would get with those individual strategies. And this is what you get with the Galerkin method. So you get a huge reduction. If you go through all the 529 strategies, the best one gives you the value of 1020. So making this simple convex combination, you actually come up with completely new investment strategies, which can hugely improve over the existing strategies. Now that's, although it's very simple, it's very nice. If you take 2 constant proportion strategies and you take a convex combination of those, that's something new. It's no longer a constant proportion strategy. Well, anyways, and here are the, yes, I will conclude. So I just talked about the asset liability management problem. Then if you do the line search with respect to the initial capital, the reserve, then you can find the value which gives the good enough optimal value in the asset liability management problem. And then you get the optimal reserves. And here are the numbers. We calculate the reserves for different confidence levels in the C-VAR risk measure. And you, like you'd expect, if you have higher, like lower tolerance, you need more money. So, and this is just the corresponding funding ratios. And here's the picture which shows the development of the wealth of the company. It shows that if you choose the value at risk with 34% confidence level, picture just shows that after the line search, that quantile goes exactly to zero. So that's basically a mathematical, graphical picture of the budget constraints we had in the problem. So I guess I should stop here. There's some trivial remarks, but thanks for listening.
Questions?
Well, I may make a comment. I think that these risks as well interact with the other general risks I was mentioning earlier, and that was very clear in the way you introduced them. I mean, you look at it more from a point of view of incomplete markets, which is of course suited to the insurance thing. And what is one of the main issues is how to really estimate the processes that underline the valuation, like mortality event or. Do you see any possibility that the underlying market can grow and provide us some implied information on these processes, or do you think we will have to keep using, more objective, so to speak, measure type of or actuarial type of estimation for the risks?
Here, the risk factors that are modeled were not the prices of longevity-related products. We were just pricing a huge longevity-related product. And in this problem, we have a short position in the longevity product. So in that sense, there's no credit risk here. But you mentioned earlier these longevity swaps, which have been developing over the markets, and they have been proposed for managing risks of pension funds. For them, it would be very important to study the effects of the counterparty risk. And then once the market for those starts to develop, then you could maybe include them as hedging instruments in these kind of problems. But we are still, I think, far away from that. So the market is very immature.
I heard that there are a couple of indices that are published on longevity, but they are, if you have a custom longevity swap, clearly that doesn't help you too much, really.
There's a company that promotes these indices, but in my understanding, the corresponding products are not very liquid.
Yeah.
Thank you very much.